Welcome to the Deep Dive. Today, we're really digging into the latest Q3 2025 results from, well, one of the most talked about companies on the planet.
Absolutely. We've got earnings reports, analyst takes, even some internal stuff. And the mission today is, I think, to figure out this puzzle.
Yeah, the puzzle of how you hit record sales, record deliveries, and yet your profit just falls off a cliff.
It's this real split, isn't it? Fascinating stuff. So on one hand, you've got the good news. $28.1 billion in revenue. That's up 12% year on year, beat the estimates.
And the deliveries, just shy of 500,000 cars globally.
Yeah.
497,099, a record.
Huge numbers. But like you said, here's the other side of the coin. Net income, down 37%, only $1.4 billion. Operating income fell even harder, 40%.
Which meant earnings per share, just $1.50. Missed Street's expectations by a fair bit.
So yeah, volume looks great, but profitability, not so much. And the big question is, why does the market keep giving it this, nearly $1.5 trillion valuation when the car business itself seems to be struggling with margins?
Right.
And the answer, which we're going to unpack, seems to be all about the other stuff. The other bets, as they call them, AI, the robots' energy. That's apparently the real story, or what they want the story to be.
Okay, let's start there then, with the cars. How did they manage that massive sales number in Q3? Almost 500,000 deliveries. What happened?
Well, the thing is, that record number, it wasn't quite what it seemed. Most sources are pointing to this huge pull forward in demand, particularly in the U.S.
A pull forward, meaning
people rushed to buy before the end of September because that $7,500 federal EV tax credit, it was expiring. So it created this artificial surge right at the end of the quarter.
Okay, so they basically borrowed sales from Q4, potentially even Q1 next year, just to hit that Q3 number because of the deadline.
That's the rate, yeah, which implies Q4 could be, well, a bit rough on the demand side.
Okay, so that explains the volume. But what about the profit crash? Where did the money go?
Right, the headwinds. There are a few big ones. First, margins. Automotive gross margin, and this is excluding the regulatory credits, it fell, dropped to 15.4%. That's lower than expected and way down from where it used to be.
15.4%. Okay, that's tight.
Yeah.
What else? You mentioned R&D earlier.
Exactly. Costs went way up because they're funding these future bets. Operating expenses jumped 50% year over year. 50, a huge chunk of that is R&D for AI, for Optimus, for all these future projects.
So they're spending heavily now, knowing it hurts the numbers today, banking on a future payoff.
That seems to be the strategy. And the third thing hitting profit was those regulatory credits. The money they get selling credits to other car makers.
Was not making enough EVs themselves.
Yeah, that income stream is drying up. It fell 44% in Q3, down to about $417 million, which tells you something interesting.
What's that?
It means the legacy automakers, Ford, GM, others, they're actually making more of their own EVs now, so they don't need to buy as many credits. Plus, tariffs went up too. Over $400 million hit this quarter. Another cost pressure.
Okay, so margins down, R&D costs way up,
Yeah.
credit revenue falling, tariffs rising, and I assume competition isn't making things any easier.
Not at all. The competitive landscape is getting fierce. Look at the U.S. market share for EVs. Tesla dropped from 49% a year ago down to 41% now.
Wow, that's a significant drop.
It is. And in Europe, their sales were actually down 20% in Q3. But here's the kicker. The overall EV market in Europe was up 30%.
Down 20 when the market's up 30.
Oh, yeah.
Ouch, that suggests.
It's just competitors like BYD, VW, they're really eating into Tesla's share. And maybe, some buyers are getting tired of the Model 3 and Y. They haven't had major updates in a while. The lineup's getting a bit old.
That definitely paints a picture of, let's say, a maturing auto business facing some serious headwinds. But they still ended the quarter with a ton of cash, right?
They did. That was the silver lining, maybe. Record free cash flow, nearly $4 billion. Pushed their total cash and investments up to $41.6 billion. That's a big war chest.
$41 billion. Yeah, that's serious ammo to fund those big future bets we talked about.
It is. It gives them options, liquidity. But we need to look at how they got that record free cash flow number. Because free cash flow is, basically cash from operations minus your capital expenditures, your CapEx.
Right. Money spent on factories, equipment, that sort of thing.
Exactly. And their CapEx in Q3, it was down a lot, like 36 or 37% lower than the year before.
So the free cash flow looks amazing, but maybe partly because they held back on spending on, say, future factory needs or tooling.
That's the argument some analysts are making, yeah. It's like boosting your household savings for a month just because you skipped essential home maintenance. You save cash now, but the cost is still coming later.
Okay, that's a really important nuance for you, the listener, to grasp. So they have the cash, but maybe they're achieving that partly by shifting spending away from the core auto business.
And channeling pretty much everything towards AI. Which brings us to that AI pivot. The CEO's comments were pretty striking here. Called it a critical inflection point for real-world AI. Said autonomy will be a shockwave.
He certainly wasn't holding back. And the core idea is that their advantage comes from all those cars already out there, gathering data, right?
That's the thesis. That data pipeline feeds the AI development. They announced FSD, the full self-driving beta, or supervised as they call it now, has logged 6 billion miles. 6 billion.
That's an astronomical amount of driving data.
It is. But here's the catch. Even with all those miles, the actual take rate, the percentage of owners using it, still pretty low, around 12% maybe, so it's still very much a work in progress despite the mileage claims.
And underpinning all this AI ambition is the hardware. They're not just relying on off-the-shelf chips, they're designing their own. This AI 5 chip, why go to all that trouble?
Well, their view is that true autonomy needs custom silicon. Hardware designed specifically for their software and their cars. Nobody else can do that quite the same way. The CEO talked about radical simplicity in the AI 5 design.
Radical simplicity, how so?
By stripping out stuff they don't need, things you'd find in a normal NVIDIA GPU, like legacy graphics processing or standard image signal processors, they just delete them because they only have one customer for this chip themselves.
And cutting those features lets them do what? Make it faster, cheaper.
Both, potentially. It lets them focus purely on neural net processing, and physically, it lets them shrink the chip design to fit on what they call a half reticle.
Okay, half reticle. Quick translation for us non-chip designers.
Right. So a reticle is like the stencil used to print chips onto a silicon wafer. A smaller design, a half reticle, means you can print more chips per wafer. That cuts costs way down, increases the number of working chips you get, and boosts the performance per dollar. Maybe, they hope, by like a factor of 10 compared to buying chips from someone else.
And the performance claim itself. For AI 5 versus the current AI 4.
The claim is big, up to 40 times better, or, as they also phrased it, a safely 10x improvement in capability, so somewhere between 10 and 40 times better. That focus on their own needs is what they see as their competitive advantage, their moat.
And they're serious about supply, splitting manufacturing between Samsung in Texas and TSMC in Arizona.
Yeah. They want redundancy and, crucially, what they termed oversupply. The idea is any chips they make that don't immediately go into a car or a robot can be used in their own data centers for training the AI models. They want to ensure they never hit a hardware bottleneck.
Okay, so the chip strategy is clear. What about actually deploying this stuff? We're seeing robotaxi tests already. How's that progressing?
It's moving. Cautiously, maybe, but moving. The ride-hailing service is running now in limited areas, Austin, the Bay Area. The big test, the milestone they've set, is removing the human safety drivers entirely in large parts of Austin by the end of this year.
Removing the safety driver by year end. That's ambitious.
Very. If they pull that off, it's a huge step. And then looking further out, there's the dedicated robotaxi vehicle, the Cybercab. You know, the one with no steering wheel, no pedals. Production is apparently slated for Q2 next year.
It really feels like the cars are becoming, almost secondarily, just platforms for the AI. And the primary platform, the real end game, seems to be Optimus, the robot.
That's where the ambition goes completely. Well, sci-fi. And it's why that huge R&D spend we talked about starts to make a bit more sense, strategically at least.
Is there any company you can think of that's bet so much on something that basically doesn't exist as a mass market product yet?
I mean, the scale of this bet is enormous. That 50% jump in operating costs, it's seen internally, it seems, as just the cost of entry for Optimus and autonomy. The car business is kind of the funding engine and the distribution network for this future vision. The CEO literally called Optimus potentially the biggest product of all time.
Biggest product of all time. End poverty, act as a surgeon. The claims are staggering.
They are, and it highlights the incredible engineering challenges ahead.
Like what specifically?
Well, one example they mentioned is just the hand. Developing a truly human-like dexterous hand and forearm. Apparently, that's considered more difficult technically than building the entire rest of the robot.
Just the hand. Wow.
Yeah, it shows you how complex replicating our own dexterity is. We just pick things up, manipulate them, recreating that mechanically. That takes billions in R&D, specialized actuators, advanced sensors, sophisticated software.
And that's just one component, and then they're scaling it. They're talking vehicle-level volumes, right?
Right. The goal is eventually scaling up to make maybe 1 million Optimus units a year. 1 million. And think about this. There's no existing supply chain for humanoid robot parts at that scale.
So they have to build it all themselves.
Pretty much. Massive vertical integration. They have to design and make the motors, the sensors, the actuators, everything is building an entirely new industry from the ground up. They did say expect to see a V3, sort of a production intent prototype, in Q1 next year.
Okay. Which brings us, inevitably, to the massive controversial pay package proposal. Because the CEO is tying all of this, the robots, the AI, directly to getting that package approved.
Yeah, the multi-billion-dollar, potentially trillion-dollar based on market cap pay package, if it gets approved, it would boost his voting control significantly into the mid-20% range. And he's been very clear why he wants that.
What's his stated reason?
He says he needs that level of control, that strong influence to steer these huge, potentially world-changing AI and robotics ventures. He literally asked, if he builds this enormous robot army, could he just be kicked out later? He wants to ensure he stays in charge of it.
But the pushback has been intense. Proxy advisors, ISS, Glass Lewis, they told shareholders to vote no. Why?
Their main arguments were about the sheer size of the award, unprecedented, and the dilution it would cause for other shareholders. They also questioned the metrics, arguing that basing it purely on hitting market cap targets isn't tied enough to say actual profitability or operational success, which, given the margin issues we discussed,
is pretty relevant.
Right. And the CEO's reaction to the advisors recommending no, he called them corporate terrorists.
Strong words. It really shows how high the stakes are perceived to be internally.
Extremely high. He's basically forcing shareholders into a corner. Approve this massive package, accept the dilution, or risk losing the leader who embodies this entire AI and robotics vision. He even threatened to, potentially take these ventures elsewhere if it doesn't pass.
It's a high-stakes gamble. Before we wrap up, though, we have to quickly touch on the energy division. Because unlike the auto struggles, that part of the business seems to be booming.
Oh, absolutely. Energy generation and storage was the real bright spot in these results. Revenue shot up 44% year over year. $3.4 billion. They hit record deployments, too, 12.5 gigawatt hours of storage.
And they're rolling out new products there, too.
Yeah, things like the Mega Block, Megapack 3, and they previewed the next generation, Megapack 4.
And Megapack 4 has some interesting tech, right? More integrated.
Exactly. It integrates the substation components directly. It can output power at 35 kilovolts. What that means for you, the listener, is that utilities can basically plug it straight into the high-voltage grid. No need for a separate, expensive transformer station next door. It's a big deal for cost and deployment speed.
So it makes them less of just a battery supplier and more of an integrated grid infrastructure company.
That's the idea. They see energy storage as fundamental to upgrading the grid. Some sources suggest that adding battery storage widely could effectively double usable energy output in the U.S. without even building new power plants, just by buffering renewables. So yeah, Tesla wants to be a key player there, way beyond just cars.
Okay. So let's try to synthesize all this. We've got struggling auto margins, massive R&D spending, a potential robot future, a controversial pay package, and this booming energy business on the side. What's the takeaway?
I think the takeaway is we're watching a company trying to force an evolution, maybe even a revolution, in real time. Investors are clearly looking past the current auto profitability issues. That PE ratio over 250, that's not for the car business today. It's purely a bet on the AI and the robots delivering massive future revenue streams.
So near term, it's all about managing the auto business's margins, making sure it generates enough cash to keep funding the dream.
Exactly. Funding what they hope is the ultimate payoff, the infinite money glitch, as some might call it. Embedding AI into the physical world, first with cars, then potentially millions of robots.
It's a fundamental shift from selling electric cars to selling embodied intelligence. And maybe that brings us to a final thought for you to consider. Given this huge push for vertical integration, designing the AI5 chip, needing to build the entire Optimus supply chain from scratch, could it be that Tesla's real long-term competitive advantage won't just be the software, but its ability to design and manufacture everything from the silicon up?
That's the trillion-dollar question, isn't it? Whether mastering the hardware from chips to robot hands is the key. Only time, or maybe a very dexterous robot surgeon will tell us that.